What an action-packed Wednesday it has been for the markets. The RBI has increased the repo rate by 40 basis points for the first time since June 2018. Remember, this was an out-of-turn interest rate hike, and the RBI governor in his statement mentioned that the external factors make it imperative that we go ahead with a rate hike at this juncture, given the fact that inflation print also remained near that 7% mark in March, and in fact inflation print for the month of April is also expected to remain elevated. In fact, economists are dreading or saying that it may even hit that 8% mark. In light of that, the RBI governor has preempted the inflation data and said that it becomes necessary for the central bank to go ahead and hike interest rates. What's interesting is that it comes along with a CRR hike, the cash reserve ratio hike of somewhere around 50 basis points, which is now, the CRR now will be at 4.5%, and it will suck out as much as 87,000 crore rupees from the system. The governor also reiterated that the central bank has decided to remain accommodative for as long as necessary and will not provide a shock to the system by a sudden withdrawal of its accommodative stance. And he said that the decision was unanimous to remain accommodative, and he also mentioned that the Indian economy is strong enough in the face of external challenges like rising commodity prices as well as the fallout of the Russia-Ukraine war. Well, it was a double whammy of sorts for the markets, both the interest rate hike and the CRR hike. In the aftermath of the announcement, we saw the Nifty tumbling over 350 points and the Sensex also sinking over 1200 points. But given the fact that the global central banks have already embarked on the rate tightening path, it wasn't a surprise move by the RBI. An interest rate hike in June was already on the cards, given the fact that the inflation figures have now inched way higher than the RBI's comfort level. In fact, inflation for the month of March is hovering near that 7% mark, and for the month of April, it is even expected to overshoot that 7.5% mark. So all in all, given the kind of inflation data that we've been getting of late, there was an interest rate hike on the table in the RBI's June meeting. However, since the RBI's last meeting, a lot has changed in terms of the inflation figures. So the RBI decided to conduct an out-of-turn meeting and announce an out-of-turn interest rate hikes, but the market, it seems, had failed to factor in an impending interest rate hike, even though the global central banks have started moving on a rate tightening. The RBI's move comes right ahead of the outcome of the US Federal Reserve's May meeting, in which it is expected to hike interest rates by a steep 50 basis points as inflation, US inflation hovers around that 8.5% mark, which has been hovering near that 4-decade high for quite some time. So in the face of stubborn inflation, the US Federal Reserve is expected to adopt a more hawkish tone that it had indicated in the month of March. Remember, since the Fed's last meeting, a lot has changed. The US Treasury yields, the 10-year US Treasury yields have jumped past that 3% mark. In fact, in the last meeting, we had seen that the US Treasury yields were hovering around that 1.66% mark. In fact, if you also look at the US markets, well, it's been an awful April where Wall Street is concerned, with the S&P 500 losing nearly 9% for the month. Traders believe that the next 3 meetings may see rate hikes of 50 basis points each. In fact, traders do expect the federal funds rate to hover around the 2.25% to 2.8% mark by the end of the year, and for that the Fed may have to adopt a more aggressive approach, and in fact there are some chances or slim chances of the Federal Reserve actually going in for a 75 basis point hike, but that is something that the traders want the Fed chief to clarify on, or to give some kind of hint on whether or not it will be open or whether or not it has the room to go ahead and adopt such an aggressive stance, because the inflation figures continue to hover much above its comfort zone, and to be able to bring it back to the 2% level, the Fed will have to adopt a far aggressive tone. There is a question mark or whether or not the Fed will be able to achieve a soft landing as it has been indicating due to the strength in the US economy. But if you look at the Q1 GDP data, the US GDP contracted by 1.4%, but economists believe that it will bounce back in the second quarter. When you come and look at the jobs data, well, there is nothing much to complain about there as well. And when you talk about the inflation, which is hovering at 8.5%, most economists believe that inflation figures in the US may have peaked out and that they are headed lower from here. So what is the Fed expected to do? Is it going to hike interest rates by 50 basis points?